Hi, everyone. I've getting some multiple inquiries regarding what happens when your loan escrow account dramatically goes up. I've been talking to people who had their mortgage. I thought everything was dandy, and then it went up by $1,500 a month, and they're freaking out. So I thought I'd have my lender, Austin Swift, jump on a call and go through exactly what's happening here, how to avoid it in the future, and what are the next steps when you see this happen. Everyone, this is Austin Swift. He's one of my loan officers. I work with him a lot, and I wanted to talk a little bit about what happens when you have an escrow shortage on your loan. Some people have been talking about how their mortgage has gone up significantly. I've had it happen to myself as well, where my loan went up $1,500. And I was like, whoa, what happened? So I called Austin and wanted Austin to jump on and explain exactly why this happens and what are some steps to make sure it doesn't happen on future loans, as well as what you should do and what's the process to kind of investigate what's going on there. Is it what we're talking about, or maybe it could be something different?
Okay, my name is Austin Swift, and I'm with Movement Mortgage. I've been in the business for almost 20 years now, and that's the thing that always comes up. And there could be multiple reasons why the taxes or the insurance has caused your escrow shortage. And I say those two things because those are usually the ones that change over time. Because mortgage insurance is going to stay the same, and most of the time it decreases, it doesn't increase. So with the property taxes, sometimes it can be if you're in the middle of your loan and you do any type of rehab, and if you have to file your permits with the county, if the assessor can notice that you added an addition in the back, but you didn't necessarily report, or the county doesn't have laws that say that you need a permit, they're going to ask what the square footage is going to be. That could possibly increase your taxes. So, in some cases, for myself, I redid the entire basement, and we added an egress, which that will increase your livable square footage. So my property taxes went up probably about $1,000 because of that increase.
Oh,
So I was anticipating that it would be more, but it went up a lot more. And one thing is, because in this environment, it's crucial to understand this, because some people don't necessarily look at their tax bills. So I not only had the improvement increase, but somehow our property assessments doubled.
oh wow.
So yeah, and that was just because our, like, I want to say our property values increased like 50%. And where my county in Indiana, this is what I'll get into a little bit later too, but my county in Indiana, they were assessing it at like 300,000.
Mm.
And in most cases, it was 500,000 or 600,000. So when you have that disparity because the county's behind on their assessments, you could see a large jump. And the first thing out of the gate, you're going to blame the mortgage company because they're the ones that are paying it.
Hmm.
But in actuality, sometimes it's just the county trying to catch up with the modern values. And sometimes and the other thing is, if you see that your county's slow on the assessments,
Hmm.
there could be something that the county council did that has caused more not assessments, but more taxes or a tax increase.
Got it. So
So
that's
that's
something
out of
more
the
like
norm.
in the middle of your loan. So you've had your
Yeah,
mortgage for many years.
right.
There's been a spike. You're like, whoa, what's happening?
Right.
But in the
Now,
beginning, say like the first year or
yep,
two, that's where the big potential spike could be. Whereas a thousand
correct.
dollars in taxes, that sucks, but it's
Yeah.
dispersed over 12 months. How about
Now,
$10,000 in taxes?
right. Now, the reason why I brought that up was because that could be part of your perfect storm as well. So when you buy a property, what triggers the county to do these assessments are new purchases. So I was trying to compare Indiana to California because I know that that's where we're at, right?
Yeah, everyone's
And
probably confused because they're like, what? Indiana? So anyone
yeah,
who's like dialed in, who's like, why is Sarah in California talking to a lender in Indiana? Well, a lot of my investment properties are in Indiana, and Austin doesn't just do Indiana. He does all over the United States. So he also helps me like California properties as well. So he's got a hand
yep.
in multiple markets and knows about the rules in all those markets. So it's been very helpful to work with him.
Now, the big kicker on this is when I was looking at, and this is where you might want to move out to Indiana, is
One of these days.
right. So, as a buyer, so let's take it from the homeowner to the buyer. What can the buyer do to make sure that they can fully afford the property? And it's mainly going to come down to your research with the county and taxes. So when you click on Zillow and you're researching that property, there's a little tiny bar that says check county websites. If you click on that, that'll take you to the county tax, the tax authority. So whether it's done through the assessor or through the treasurer, it's going to take you where you need to go to look to see what taxes are. I would suggest, because what I found with your property is your seller was in the house for 30 years.
So he had like $1,000 property tax bill. That was
Yeah,
it.
right. So then what you need to do to like you should know that if you're buying a property and it's let's just throw out $1 million. If it's $1 million, the it you will not have a $2,600 tax payment for the year. Most likely it's going to increase. And rule of thumb, usually it's 1% of the value, or not the value, but the purchase price. So on that piece, it's probably going to be $10,000. However, how you can tell what it would increase to is by, and this is the reason why I love Zillow, is because it will give you the houses that are propped up, that popped up, that have sold. And if you go with one that sold last year, that tax amount is probably going to be what yours is going to be. So if you find a like property or a like sales price, that's a way to know what your future value is.
And so why is it
Now,
important for us to know this? Because we're all thinking,
here we
okay,
go.
it's already handled. We got the underwriters handling it. We got title. We got our agent. What are we looking for? And how do we make sure that this is happening? Because we can do it ourselves, but we all assume that's already happening.
Right. So if you can't find anything and you've already made the offer, one way to check in is whoever the loan officer is going to have contacts with the title company, with the underwriters, with the processors, all the people that can somehow manage to give you what, because they're never going to get it down to the penny,
Of course.
but they're going to give you a good assessment to where you're like within like, let's call it $500.
Hmm.
And the one, the thing that you got to look at with your loan officer is most try to give you the least amount of settlement charges, or you're in a program where they need
Well,
your
why don't we
qualify.
stop there?
Yeah,
What exactly are settlement charges? Because that might be common to most people who are
yeah.
watching right now.
So settlement charges are also nicknamed closing costs.
There we
I
go.
like to use settlement charges because it sounds better.
Sounds nicer. Yeah.
Right. And then so the settlement charges are going to be what the lender charges you for the rate, what their administration costs are, Then what are you going to pay for the taxes? What are you going to pay for the insurance up front? And then your escrows and then the title fees. So what we're looking at right now with this conversation is with the taxes and the insurance. The insurance, you're already going to get a quote because you should be the one getting the quotes from the insurance companies. But the taxes, it's it's going to be hard to assess if the loan officer is not engaged with those parties, because the loan officer can see the tax cert that comes in that they request when they open your file.
Hmm.
And the tax cert comes from the title company. So in your case, in each county of California, and some other states out west too, mostly are all do pretty much the same thing. But specifically, let's just talk with California. The title company has it broken down even to cities, what is called a mill rate. And mill rate, what it means is it's a abbreviated Latin term for 1,000. And so how they use the tax rate, a it's one no per 1,000 of the assessed value.
Hmm.
And what they assess, how they come up with the assessed value is basically your purchase price. So when they do your purchase price, they update the tax rate. So when you record on the day of closing, that's when your taxes are due.
So ideally, in a perfect world, they're going to use this mill rate. However,
Correct.
sometimes that's not the case, correct?
However, yes, sometimes that's not the case, but it's the case in my it's kind of the case in my county, but
Yes.
there's more confusing things that can happen, and I'm going to make that comparison shortly. But for California, usually, from what I'm told, anywhere between 1% and 1.25% will get you within that $500 that you want to know what your future taxes are going to be.
Got it. And in my case, what happened was they didn't actually use this mill rate. They used the property tax that was pre-existing for the previous owner, and they lived
Yep.
there 30 plus years. So I went from $1,000 tax bill to over $10,000, which wasn't accounted for. So I got a surprising, oh, you get an extra $1,500 a month payment for X amount of months, and then it's going to drop down, but not down to the original payment. So it's very important to know these things so that if you're in a loan and you're maxed out on what you can pay on a monthly basis and this happens, luckily I was able to float it, but not everyone is able to, which is why this conversation is really important.
Yes. And the situation with yours is, and I found this out through because I'm no longer with the prior company, but we had you qualified higher amount, and the closer assumed that you wanted to bring less to the table.
Mm.
And so the closer, and the reason why I bring up closers is because we're all rushing at the end,
Oh, of course.
right? So most deals now can be done 7 to 10 days, but sometimes there's always that file or always that closing where they're down to the last wire. And now you're
Hmm.
creating rushes. And this is crucial because most likely these are going to be where the mistakes are made.
Yeah, and is it
And
sometimes
maybe not.
beneficial for them to use the existing tax amount and not the mill rate? Like if you're trying to qualify and you're right on the wire and you're aware of this, but you're
Yes.
trying to get into the door.
Yes. Now in California, most lenders are smart enough, they're going to catch it and they're not going to let it slide. However, in Indiana, and this is where you're going to hate me, and I might as well bring it up now, but we use homestead exemptions.
Hmm.
In California, the homestead, like you saw, it only decreased your payment by $70.
$70 tax
Yeah.
savings. That's it.
In Indiana, that assessed value, right? So how the homestead exemption works in Indiana is you basically can take off about I want to say 40% of the assessed value.
Oh.
And yes. So because I was looking at that comparison, I was like, this can't be right. 40% and you only get $70. But that's the
Yep.
case. And that can even happen in each county of every state. So that tax rate and the mill rate, what goes into that, you can even break it down even further, is school districts, it's counties. So, and where that comes into play, if you're investing in Texas, they have, I want to say, 6 different taxing districts. So you could be school taxed, you could be county taxed, you could be, they even, if you're in Galveston, you get a port tax. So yeah, happy day.
Oh yeah, we're familiar with the Melrose
So
taxes out here for the schools. If you live in a new development, you got hefty Melrose taxes. So
right. So then you got, so the mill rate and tax rate are usually the same, but the county will have a subtotal. So you're going to get this document that says assessed value. It's going to say this is not a bill, but it's going to break down how much they like, how much everything is calculated.
hmm.
And then you have that grand amount. So for me, my mill rate is 2.06. Now that's 2.06 on half of my value, basically.
Because of the homestead.
Yep, because of the homestead. So if you really wanted to break it down on what I said earlier, between 1% and 1.25%, if I were to just do 1.06 of the total assessed value without the homestead, my property taxes are in line.
Hmm.
So really, the homestead exemption gives me 1% off.
Got it. But for us California people, just ignore it. You just had a dinner out.
Right.
That was your that was your
Yeah.
tax
But
exemption.
if you
Maybe dinner.
calculate, yeah. So that's why a lot of people are moving too. But if you look at it, um, between 1% and 1.25%, that will
Hmm.
get you within $500 usually of what you're about to pay. And it's not necessary. I mean, it is, I would say it falls into everybody's mistake because the loan officer at any point can make that clarification for you.
This is
The
good for
borrower,
everyone to know, just
yeah,
because it can come up, things get missed, and normally you don't have someone living in a property for 30 plus years. That's not as common
yeah,
these days, but it does happen. Then you get hit with something if you're not, if everyone's not in line with that. So it's important
yeah.
that we all know this.
And then the other thing too is, and the reason why I bring up insurance as well, and this is why we all have to check now going forward. I would say you got to check your insurance, and rule of thumb is every year get a quote from other insurance agencies, because I've had multiple clients within the last 5 months call me and say that their insurance has doubled.
Well, California is losing insurance providers left and right. So
Yeah,
it's kind of hard to switch out here.
it's sort
You
of like
still
Florida.
can.
It's,
Yeah.
it's sort of like Florida. Well,
Hmm.
the other crazy thing about it is what I've noticed too, and looking at some of my clients' quotes, some of my clients are not being, so I want to say this is probably because they added or did an addition or they made a room, right? When my clients tell me that the property has 5 bedrooms, I can sometimes I see on the insurance quotes they're 3 bedrooms.
Hmm.
So insurance agents, to beat out other people, are not inputting the right data
Oh, that's
into
dangerous.
it. Yeah. So,
Because
and
if you
where
have to
this
have a
comes,
claim,
yeah,
it's not going to help
or
you.
potential rebuild. And like, I would say California probably, well, I don't know how many tornadoes you get, but let's just call it earthquakes,
Earthquakes are
mudslides,
here.
right?
Mhm.
Mudslides, earthquakes, floods. If there's a potential for a full rebuild and your insurance quote has 3 bedrooms, 2 bath, they're going to
Oh, we lost you there.
can you hear me?
Yeah, now I can hear you. So
Okay.
if they lose their property, have to rebuild, and it's a 3 bedroom, but their house is really 4 or 5 bedroom, you're
Yep.
gonna get the 3 bedroom.
Yep. And then it's going to be a long drawn out process of litigation if you go that route.
Mhm.
And that's happened to one of my clients as well. That happened 2 years ago. And and they were involved in a hurricane.
Oh.
And it was a whole rebuild because a tree took out half of their home. So it could happen anywhere. You just have to pay attention. When a lot of people will disregard their taxes because they think that their escrows, since their escrows are included, they don't worry about it. They throw out that thing, and then their insurance quotes, you don't necessarily pay attention because, again, the mortgage company's paying it, but you have to, because right now, like, anything could happen and you never know.
Mhm.
And then one last thing that you should really look at is on the taxes. You have to the bill, because if you're because what some of these counties are doing is they're sending you, because here, let me take back. When you first bought your home, how many times did you throw away stacks and stacks of junk mail?
Oh, lots and lots of junk mail,
Okay.
of course.
So, and the reason why I was pausing, because I was trying to come up with this example, but
Mhm.
what the counties are doing is they send you a document that tells you about your homestead exemptions,
Mm.
and it looks like junk mail, and you'll wind up throwing it away. But
Well, you
what
get
they're
a lot of
doing,
stuff too that it
yeah,
looks like it's county, but it's not, and it says on
yep,
top, "This is not required, this is not from the government," they make it look like it's from the government, so you get a
yep,
lot of that mixed in there, so I can see how you would miss that
yeah.
homestead information.
And so what they're doing is they're sending it to you by mail because they know that you'll hopefully open it, but they're verifying homestead exemptions. So for my county or my area, it's crucial that we open up that and we check mark the box and send it in, or go online and re-verify our homestead, because we save so much money.
Mhm.
My taxes would double. However, in yours, it doesn't
It's
really matter.
70
I mean,
bucks.
it's $70, right? Like, you can take the time to do it, but let's just say they change, right?
Mhm.
Like, say they change the way that they do taxes, or let's say you're used to the way LA does it, but if you move north, right, right near the Oregon border, they might be doing their taxes a little bit different in that county,
Mhm.
and they're more similar to like mine. You have to look, and you just have to pay attention to the homestead. I would say once every 3 months, log in. So that way you can make sure that your homestead's there, your mortgage deduction can be there, and um, you know if there's going to be a shortage and it's not a surprise. That's pretty much it.
Wonderful. Well, that was really helpful. So we just have to make sure when we buy a home that they're using the mill rate. They're not using the previous owner's tax rate, which could have
Yep.
been a fraction of what we have to pay.
Yeah.
Make sure we check our homestead, whether you're LA in 70 bucks or you're in Indiana, it's like half your property bill. So these are some really great things to check on and make sure. And then the other thing I wanted to ask you too
Yeah.
was, if you have any questions about your escrow account or things going in and out, what should you order? What things should you ask your mortgage company to get a good account of what's going on with your escrow?
You can talk with them, and it's usually the servicer, and that can be found on your mortgage statement or within your mortgage portal. But it's called an escrow analysis, and they're supposed to do an escrow analysis once a year. However, you can ask for them to reassess your escrow account or provide more of a detail. So if you had a credit or if you had a debit out of that escrow account and you wanted a more breakdown answer of what was this and why is this on there, that's what you would want to do, the escrow analysis, to get a better understanding. Now, there's not necessarily, usually with most servicers, there's not a number to call,
Mhm.
but there's usually an email that you can request.
Mm.
the escrow analysis, and I think you got some, like, why we were talking, you got a response back, I think,
Yeah, I
right?
got well, I had someone the email wasn't working, but I had to call in because they discontinued the email, but they normally have some way to contact them to get your
Yeah.
breakdown and everything. Yeah.
Sometimes it's really quickly. Other times it could be 24 to 48 hours. It just all depends. But you gotta, if there's any questions at all, if you submit for an escrow analysis, that should give you a full breakdown of what it looks like. And then obviously if it looks like Spanish or if it looks like foreign language, then obviously you want to make that phone call and have them explain to you over the phone.
Yeah, and it's important because, even as a kid, I caught banking errors. So, I mean,
Yeah.
there's always mistakes across the board. So it's a good idea to keep an eye on your escrow account, make sure everything looks right to you, and then you keep an eye on your taxes and stuff like that so you don't get those surprise increases.
Right.
Well, thank you so much, Austin. I really appreciate you jumping on this Zoom call so we could explain this to everyone. Hopefully, this was valuable information.
Oh, you're very welcome. And I'm glad I can be of help, and hopefully it helps everyone. But if
Well,
it helps a few, it definitely made.
I will include your information in the comments below, so you'll have Austin's direct contact info to reach out to him if you have a loan you'd like to use, as well as you can reach out to myself if you're in California. Happy to help, and we'll have some more videos coming your way.